Now, how are real estate investments valued? Before getting into the valuation, we need to note the investment process, which starts with the purchase of the property, followed by significant cash outflows used to improve the property. Then depreciation expenses which may affect the after-tax income. Then the generation of rental income. And finally the sale of the property. Therefore, the timing and the size of the cash flows as well as the taxes play an important role in the evaluation process. But these factors are difficult to predict. To overcome this challenge, the internal rate of return, or IRR, is commonly used to evaluate real estate investments. Note, however, that the IRR requires the analyst to make assumptions regarding the financing rate for outgoing cash flows and a reinvestment rate for incoming cash flows. So, for simplicity, managers often refer to cite a multiple of invested capital, or MOIC, on total paid-in capital. The MOIC is the measure of the total value of all distributions plus the residual asset values that are unsold yet relative to the initial entire investment. Though this metric is quite simple, it ignores the timing of the cash flows. The accounting-based values of a real estate investments report the assets at their historical cost and do not reflect the future potential of the investments. Another drawback of the accounting metrics is that the mark-to-market process is challenging and lagged, thereby potentially giving false signs of positive returns in the short term followed by disappointing results in the long term. Furthermore, the mark-to-market process causes accounting valuations to look more resilient and less correlated than they actually are. So, the interim valuations can be affected by inaccuracy, skewness, and the illusion of low volatility due to a lack of transparency and slow marking to market. Quartile ranking is another tool used to assess real estate managers. With quartile ranking, a manager's performance is benchmarked against a group of peer investment vehicles built with the same attributes at the same time of funding. The cap rate is another performance measure for real estate managers. The cap rate is the annual rent earned net of vacancies divided by the price for the property. However, this approach has its limitations since it does not consider the true value of the property. Find the full real estate characteristics and performance evaluation video on www.cognivisio.com.